Harold sat at his kitchen table in early February, a shoebox of receipts in front of him, the same way he'd done his taxes for the last 40 years. He filled in the numbers exactly like always, exactly like he was taught, exactly like he'd done since he was 35 years old. He didn't realize that the rules sitting quietly behind that form had changed the moment he turned 65, and that his old habits were now costing him money the IRS was never going to tell him about. This isn't a story about fraud. It's a story about a tax code that shifts beneath your feet the moment you cross a birthday, and almost nobody warns you when it happens. Here's the trap nobody explains clearly enough. Turning 65 doesn't just qualify you for Medicare. It quietly changes your standard deduction, your filing thresholds, the taxability of your Social Security income, and the rules around required withdrawals from retirement accounts. Most retirees keep filing the way they always have, using the same mental playbook from their working years, while the actual math underneath their return has completely changed. And the danger isn't that you'll get audited. The danger is that you'll silently overpay, year after year, money you can never get back. This is where the trap closes. The IRS doesn't send a letter announcing your tax situation just changed. There's no warning system. There's no built-in nudge. You're expected to know, and if you don't, the cost isn't a one-time mistake. It compounds every single filing season you get it wrong. Let's break this down into the 3 layers most retirees miss. The first layer is the deduction blind spot. Once you turn 65, you become eligible for an additional standard deduction on top of the normal one, and this amount is even higher if you're also legally blind. People who've used the same software settings or the same accountant checklist for decades frequently miss updating this, especially if they're filing jointly and only one spouse has crossed the age threshold. This is the part most people miss. It's not a small rounding error. It's real money left on the table, every year, for the rest of retirement. The second layer is the Social Security taxation trap. Many retirees believe Social Security income is simply tax-free. It isn't. Depending on your combined income, up to 85% of your Social Security benefit can become taxable. The dangerous part is that the threshold for this isn't adjusted generously for inflation, so retirees who take modest withdrawals from a 401k or IRA, or who have part-time income, can accidentally cross into a bracket where a portion of income they assumed was protected suddenly isn't. The third layer is the required minimum distribution collision. Once you reach the age where the IRS forces withdrawals from traditional retirement accounts, that mandatory income stacks directly on top of Social Security and any pension income. This is where families lose everything they didn't see coming, not through a single bad year, but through a slow-motion tax bracket creep that pushes retirees into paying significantly more than they planned for, year after year, simply because nobody coordinated the timing. And that changes everything. Picture 2 retirees, both 68, both with similar retirement savings. Retiree A keeps filing the old way, takes the standard required distribution without planning, and doesn't adjust for the extra age-based deduction. Retiree B works with a tax-aware strategy, claims the full additional deduction, and times withdrawals carefully to stay under the Social Security taxation threshold. Over a single year, the difference might look like a few $1,000s. Over a 20-year retirement, that gap can compound into well over $50,000 in unnecessary taxes paid, money that could have stayed in a household, in an emergency fund, in a grandchild's education account, instead of going to a mistake nobody flagged. This is where most retirees sit in quiet frustration, assuming the tax code is simply unfair, when in reality, the danger isn't the law itself. The danger is filing on autopilot. Here is the defense plan, step by step. First, confirm you are claiming the additional standard deduction for being 65 or older, and verify it's applied correctly for each spouse individually if you're filing jointly. This single checkbox is one of the most commonly missed adjustments on senior tax returns. Second, calculate your combined income before you withdraw from a retirement account, not after. Combined income includes your adjusted gross income, non-taxable interest, and half of your Social Security benefit. Knowing this number before you act lets you control how much of your Social Security becomes taxable, instead of finding out after the damage is done. Third, map out your required minimum distribution timeline in advance, ideally years before it begins. Strategic withdrawals taken earlier, even small ones, can sometimes reduce the size of forced distributions later, smoothing your tax bracket instead of spiking it. Fourth, review whether a portion of your retirement savings could benefit from conversion strategies while you're in a lower bracket. Done carefully and with professional guidance, rather than reacting once the IRS mandates the withdrawal on its own terms. Fifth, work with a tax professional who specifically understands retirement age filing, not just general tax preparation. The rules that apply to a 35-year-old filer and a 70-year-old filer are not the same conversation, and treating them the same is exactly how this trap survives year after year. This is the part most people miss until the refund, or the bill, lands in their mailbox. The tax code doesn't get simpler after 65. It gets more layered, more interconnected, and far less forgiving of outdated habits. Harold's shoebox of receipts wasn't the problem. The problem was a set of invisible rule changes that arrived the same year he did, rules that quietly reshaped what he owed without ever announcing themselves. Every tax season you file the old way is another year of money you can't recover. If you haven't filed yet this year, you still have time to review these thresholds before you submit. If you've already filed for years without checking, the most important step now is getting a professional review before the pattern repeats again. Delay doesn't make this simpler. It makes the gap wider. If this made you stop and reconsider how you've been filing since turning 65, like this video so it reaches someone else before another tax season slips by. Subscribe for clear, serious breakdowns of the financial rules retirees are expected to know but are never actually taught. And in the comments, tell us the age you turned when your filing situation changed, because someone reading this needs to know it's not too late to correct course.